Welcome back to the channel. Today, we're diving into the top 4 investments that can generate passive income in 2025. If you're looking to grow your wealth and secure your financial future, you won't want to miss this. It's about making your money work for you, not the other way around. We all dream of that financial freedom, where income flows in even when we're sleeping. And in 2025, with the economic landscape constantly shifting, having multiple streams of income, especially passive ones, is more crucial than ever. I've spent a ton of time researching, analyzing, and even dabbling in various income-generating assets, and I've narrowed it down to 4 key areas that I believe hold significant potential for the coming year. We're not talking about get-rich-quick schemes here. These are legitimate strategies that, with the right approach and due diligence, can help you build a solid foundation for long-term wealth. We'll break down each one, look at the pros, the cons, because let's be real, nothing is without its risks, and what you need to consider before jumping in. So grab a coffee, maybe a notepad, because I'm going to lay out exactly what these investments are, how they work, and why they could be a game changer for your financial journey in 2025. We're going to cover everything from the tried and true methods that have built fortunes for generations, to some newer, more tech-driven opportunities that are shaking things up. My goal here is to give you the information you need to make informed decisions. Let's get into it. Let's talk about an absolute classic: real estate. Own a property and people pay you to use it. Rental properties generate passive income. Buy a house, rent it out, and earn cash flow. Rent covers expenses and you profit. Properties appreciate, building equity, but being a landlord can be tough. Repairs and vacancies are challenges. Property managers can help. They handle operations for a fee. Enjoy tax benefits like deductions. Depreciation and mortgage interest reduce taxes. No down payment? Try REITs. REITs are mutual funds for real estate. Buy shares, earn dividends. REITs pay out 90% income. Regular income without property hassles. REITs are liquid, traded on exchanges, but they fluctuate with the market. Research REITs for property types and dividends. In 2025, some sectors will shine. E-commerce boosts industrial REITs. Residential real estate remains solid. Understand market trends and opportunities. Location is key for rental properties. Good schools and low crime attract tenants. Real estate offers passive income in 2025, requires capital, research, and patience. Rewards include cash flow and wealth. Choose a strategy based on your situation. Next on our list for passive income in 2025, we have dividend-paying stocks. When you buy shares of a company that pays dividends, you're essentially receiving a portion of that company's profits, distributed back to you as a shareholder. Think about it. You invest in established, profitable companies, and they send you a check every quarter or sometimes even every month. This income can be incredibly powerful, especially when you reinvest it to buy more shares, which then generate even more dividends. This is the magic of compounding, and it can turn a modest investment into a significant sum over time. Now, not all stocks pay dividends. Typically, it's more mature, stable companies with consistent earnings that choose to distribute a portion of their profits to shareholders. Younger, high-growth companies often prefer to reinvest all their profits back into the business to fuel further expansion. So when you're looking for dividend stocks, you're often looking at well-known blue-chip companies that have a long history of profitability, and ideally, a history of consistently paying and increasing their dividends. These are often referred to as dividend aristocrats or dividend kings, companies that have raised their dividends for 25 or even 50 consecutive years. Investing in these kinds of companies can provide a relatively reliable stream of passive income. The key here is relatively reliable because, of course, no investment is guaranteed. A company can always decide to cut or suspend its dividend if it runs into financial trouble. When evaluating dividend stocks, you'll often hear about the dividend yield. This is the annual dividend payment per share divided by the stock's current price, expressed as a percentage. A higher yield might seem attractive, but it can also be a red flag. Sometimes a super high yield means the stock price has fallen significantly because the company is in trouble, and the dividend might be at risk of being cut. So, it's not just about chasing the highest yield, it's about finding a sustainable yield from a healthy company. You also want to look at the payout ratio. This tells you what percentage of a company's earnings is being paid out as dividends. A very high payout ratio might indicate that the company isn't retaining enough earnings for future growth or to weather tough times. The beauty of dividend investing for passive income is its simplicity. You buy the stocks, and the dividends flow in. You can build a diversified portfolio of dividend-paying stocks across different sectors to spread your risk. And with the advent of commission-free trading and fractional shares, it's easier and more accessible than ever to get started. However, like any stock market investment, there's market risk. The value of your shares can go up and down. That's why a long-term perspective is crucial for dividend investing. Chapter 3. Peer-to-peer lending. Becoming the bank, sort of. Let's talk about peer-to-peer lending, or P2P lending. P2P lending lets you lend money directly to individuals or small businesses through online platforms, bypassing traditional banks. You can browse loan listings, evaluate borrowers, and decide how much to lend. The potential for higher returns is a big attraction, but there's also risk. Diversifying your investment across multiple loans can help manage default risk. Remember, P2P lending isn't like an FDIC-insured savings account. Understand the risks and rewards before diving in. Chapter 4. Crypto staking, earning passive income in the digital frontier. For our fourth and final passive income idea for 2025, we're venturing into the world of cryptocurrency, specifically, crypto staking. Staking involves holding and locking up a certain amount of a specific cryptocurrency in a digital wallet to support the operations of a blockchain network. Many cryptocurrencies use a consensus mechanism called proof of stake, POS. In POS systems, instead of miners solving complex mathematical problems, network participants who stake their coins are chosen to validate transactions and create new blocks. As a reward for participating in the network by staking your coins, helping to secure it and validate transactions, you receive more of that cryptocurrency. These rewards are essentially your passive income. The amount you can earn typically depends on a few factors: how much crypto you stake, how long you stake it for, the specific cryptocurrency's staking reward rate, and the overall network conditions. The appeal here is clear. You're putting your existing crypto assets to work to generate more crypto assets. If you're already holding cryptocurrencies that you believe in for the long term, staking can be an attractive way to increase your holdings without having to actively trade or invest more fiat currency. However, crypto is inherently volatile. The price of the cryptocurrency you're staking can fluctuate wildly. So while you might be earning, say, 5% or 10% APY in staking rewards, if the underlying value of the crypto itself drops by 20%, you're still down in terms of fiat value. There are different ways to stake. Some cryptocurrencies allow you to stake directly from your own wallet, giving you full control over your private keys. This is generally considered the most secure way, but it can be technically complex for beginners. Alternatively, many cryptocurrency exchanges and specialized staking-as-a-service platforms offer staking pools. You delegate your coins to them, they handle the technical aspects of staking, and you receive your share of the rewards, minus a small fee. This is much more user-friendly and accessible, especially for smaller amounts, but it does introduce an element of counterparty risk. Another consideration is lockup periods. Some staking mechanisms require you to lock your coins for a specific period, during which you can't sell or move them. This could be a few days, weeks, or even months. If the price of the crypto crashes during your lockup period, you won't be able to sell. For 2025, as the crypto space continues to mature, we might see more established POS networks and potentially more regulated staking services, which could reduce some of the risks. However, the regulatory landscape for crypto is still evolving globally, and that uncertainty is something all crypto investors, including stakers, need to factor in. Choosing which cryptocurrency to stake is also a critical decision. You shouldn't just pick a coin based on the highest staking APY. You need to research the project itself, its fundamentals, its team, its technology, its community, and its long-term prospects. Chapter 5. Your 2025 Passive Income Blueprint. What's next? Thanks for watching. If you found this video helpful, make sure to hit the like button and subscribe for more tips on growing your wealth. Let us know in the comments which investment you're most excited about for 2025. We've covered a lot today, from the solid foundations of real estate and dividend stocks, to the more modern approaches of P2P lending and crypto staking. Each of these has the potential to generate passive income, but they all come with their own unique set of benefits, risks, and requirements. The key takeaway here is that building passive income streams takes time, effort, and smart decision-making. There's no magic bullet, and what works for one person might not work for another. Your financial goals, your risk tolerance, and the capital you have available will all play a big role in determining which of these strategies, or combination of strategies, is right for you. Do your own research, consider consulting with a financial advisor, and never invest in anything you don't fully understand. Remember, the journey to financial freedom through passive income is a marathon, not a sprint. Start by educating yourself, then take small, calculated steps. As you gain experience and your income streams start to grow, you can then scale up your investments. The opportunities are out there, especially as we look ahead to 2025. So, get planning, get learning, and get building those passive income streams. I'm excited to hear about your progress.